Okay, students, welcome to another class. In this class, we'll be discussing, obviously, more details on. Welcome to another class, students. This is altogether the third class on consolidation. As I mentioned in the previous class, we'll be discussing different varieties of cost of investment and other things. Deferred and contingent consideration. Basically, deferred consideration means that a consideration which parent will pay in the future. Promise that certain amount parent will pay in the future. That is a deferred consideration. In that case, obviously, first you have to calculate the present value of deferred consideration. Deferred consideration, there is a promise. That is a promise to pay an agreed sum on a predetermined date in the future. Should be measured at fair value at the date of acquisition, taking into account the time value of money. Fair value of any deferred consideration is calculated by discounting the amounts payable to present value at acquisition. Any contingent consideration means which depends on a condition should be included at fair value, which will be given in exam. Contingent consideration is a future payment to be made provided certain conditions are met. These conditions vary depending on the terms of the settlement. Any contingent consideration should be included at fair value, which will be given in the exam. There are two ways to discount the deferred amount or to the fair value of acquisition. Simply, we can calculate present value like this. Present value is equal to future value into 1 plus R, the power is minus N. R is the discounted, N is the number of years, and this is a future value. The examiner may give you the discount factor like 0.75. Each year, the discount is then unwound. We'll come to this. Let's see. Each year, discount is then unwound by charging interest on the outstanding liability. I'll explain you each and everything. Contingent share exchange, where contingent consideration involves issue of shares. There is no liability obligation to transfer economic benefit. This potential share issue should be recognized as part of equity under a separate caption representing shares to be issued. Share exchange. Often the parent will issue shares in itself in return for the shares acquired in the subsidy. The share price at acquisition should be used to record the fair value of the shares. Let's see this example. It will give you each and everything. Calculate the cost of investment and show the journals to record in its Jack's financial statement. Show how the discount would be unwound. Jack acquired $24 million, $1, 80% ordinary shares of BK by offering a share for share exchange of 2 shares for every 3 shares acquired in BK. So parent has issued its 2 shares against 3 shares. And a cash payment of $1 per share payable 3 years later. It's a deferred consideration. Jack's share have a nominal value means par value 1 and current market value is 2. The cost of capital is 10% and value of $1 receivable in 3 years is 0.75. Okay. Calculate the cost of investment. We have to calculate cost of investment. Number one, we have to calculate the present value of deferred consideration. Let's calculate cost of investment. So number one is the deferred consideration. Deferred consideration. Logically, we have to calculate present value of the deferred consideration. Total number of shares in the subsidy, there are 24 million, which parent has acquired. Against each share, parent will issue $1, but not today, after 3 years. In 3 years' time, the discount factor is 0.75. So I'm getting 18 million. So present value of deferred consideration is 18 million. Now we have to take share exchange and let's see. Market value of shares issued by parent. share exchange. There are 24 million shares in subsidiary which parent has acquired. But parent has issued 2 shares against 3 shares. Parent has issued 2 shares against 3. Current share price of parent on acquisition date is $2. So I'm getting 32. So logically, the cost of investment is 50. So while calculating goodwill, parent cost of investment will be 50 million. What will be the double entry? Let me make that for you. Simply investment in subsidy will be debited by 50. Investment in subsidy is debited by 50 million. We have to credit the deferred consideration, that is non-current liability. Non-current liability, deferred consideration, which is 18 million. We will credit the share capital by par value and we'll credit the share premium. Parent has acquired 24 million shares, but parent has issued 3 shares against, parent has issued 2 shares against 3. So the total number of shares which parent has issued, they are 16 million. Parent has acquired 24 million shares in substrate. And parent has issued 2 shares against 3. So logically, total number of shares which parent has issued, it is 16 million. Market value of parent's share price at acquisition is $2. Par value is 1, so 1 is the premium. It means 1 is a share capital and 1 represents share premium. Because share capital multiplied by number of shares issued multiplied by par value gives us the share capital, which is 16 million. Anything which is over and above the share capital, that is share premium. Now, this is the double entry which we'll make on day 1. Now, show how the discount would be unwound. So at the year end, what happens? Basically, the deferred consideration, which is 18 million. That is the 18 million is the present value of the future amount. So slowly and gradually, this 18 million will be increased due to unwinding of discount. So at the year end, $18 million multiplied by 1.1, or you can say just take directly 10%. Cost of capital is 10%, we'll get 1.8. Debit and credit. We will debit the finance cost, 1.8 million, and non-current liability, deferred consideration will be credited. So simply finance cost will be debited and deferred consideration will be credited. So let me share a question from the past paper. Let's see. Now we have become in a position where now we should start discussing the past paper on consolidated SOFP, where we have parent and subsidiary only. Okay, students, let's discuss the entire question of consolidated SOFP. And after a few questions, obviously, we'll be then solving the question on Excel spreadsheet as well. Don't worry at all. Prepare the consolidated statement of financial position for Premier as at this 30th September X0. 20 marks question. On 1st June X0, Premier acquired 80% equity share capital of Sanford. The consideration consists of 2 elements: a share exchange of 3 shares in Premier for every 5 shares acquired in Sanford. So actually, parent has given parent has issued 3 shares against each 5 shares acquired. So it is the ratio is 3/5, and parent has taken 80% holding. So parent has issued 3 shares against each 5 shares in the subsidiary, and the cash is 8 lakh. And this cash is paid immediately, so it is not a deferred consideration. The share issue has not yet been recorded by Premier. Parent has not recorded the share issue, so we'll have to record. Simply investment in subsidiary will be debited. With the par value, we will credit the share capital, and over and above the share capital, share premium will come. At the date of acquisition, shares in premium had a market value of $5 each. Fine. Below are the summarized draft financial statement of both entities. Statement of financial position, we have asset, non-current assets, property, plant and equipment, investments. Okay. The following information is relevant. At the date of acquisition, the fair value of Sanford assets were equal to their carrying amount with an exception of its property. This had a fair value 1.2 million below its carrying amount. Wow. There's a fair value adjustment, but if you read it properly, logically, it is not the increase in the value of property, plant and equipment. There is a decrease. You can say it's a negative fair value adjustment. You can say that it is a negative fair value adjustment, 1.2 million. Had a remaining useful life of 8 years at the date of acquisition. Sanford has not yet not incorporated in its financial statement, so we'll look at this. Logically, we do have a fair value adjustment, but this time it's not a positive fair value adjustment. It is not increasing the net asset. This fair value adjustment is a decrease in the property value, so it will reduce the net assets. Premier had 2 million at a cost to Premier of inventory that had been supplied in the post-acquisition period by Sanford. So we'll come to this. Premier had a 2 million at a cost to Premier had 2 million. Okay, Central Group trading with subsidiary. I'll coming to this, don't worry at all. Then again, trade payable, something like that. They're talking on investment. Look at just read point 5. Premier policy is to value the non-controlling interest at fair value. And it is assumed that NCI fair value is 3.5 million. They have already given us. Consolidated goodwill was impaired by 1.5 million. Sanford profit for the year is 3.9 million. Fine. Now let us perform few calculation. Obviously, we cannot perform all the calculation. We have not read the complete data. At least let me show you working one. In working one, we have to just show the group structure. Premier is the parent. Having 80% holding in Sanford. So Sanford is a subsidiary. It means NCI holding is 20%. Now, very important point is acquisition period. Actually, acquisition period is just 4 months. How did I calculate 4 months? Come here. Date of acquisition is 1st April X9. No, this is not the date. Date of acquisition. Date of acquisition is 1st June X0. And we are preparing books on 30th September X0. If you count the time period from 1st June till 30th September, simply from June, July, August, September, it's a 4 months time period. So acquisition period is 4 months. This is very important. Please, student, read it again. We acquired, parent has taken 80% holding on 1st June X0. From 1st June X0 till 30th September, so acquisition time period is 4 months. Parent holding is 80%. NCI holding is obviously 20%. Now let's go to step 2. In working 2, what do we do? We just calculate net assets of subsidiary at acquisition, at reporting date, and post acquisition. Working to net assets of subsidiary at acquisition, at reporting date, and post acquisition. At acquisition, at reporting date, and post acquisition. I'm ignoring 3 zeros for the sake of simplicity. Now let's take number one, share capital. We'll take subsidiaries share capital. Let's find the subsidiaries share capital. Subsidiaries share capital is 5,000. Subsidiary does not have any share premium. So subsidiaries share capital is 5,000. At acquisition, at reporting date, there's no share premium. The main thing is now we need retained earnings. At acquisition, at reporting date. Retained earnings. Retained earnings. Now let's come here. Retained earnings on reporting date, it is 4,500. Subsidiaries retained earning on reporting date, it is 4,500. Main thing is we need to find out subsidiaries retained earning at acquisition. We need to actually find out the subsidiaries retained earning at acquisition, because examiner has not directly given us the retained earning of subsidiary at acquisition. So how to calculate? Now please try to understand. The acquisition period is just 4 months. Acquisition period is 4 months. Basically, we do have the retained earning on this date, which is 4,500. But actually, we need to find out the retained earning on 1st June X0. Now try to understand. If we simply deduct current year earnings of the 4 months. Repeat, from this retained earning of 4,500, if we deduct current year's earning of last 4 months, then automatically you will get a retained earning at 1st June X0. Repeat, we do have a retained earning 4,500 on 30th September X0, but actually we need retained earning at acquisition. And at acquisition means what was the retained earning 4 months before 30th September X0. So now we have to calculate the retained earning at 1st June X0. There's only one way to calculate. If we can manage to deduct last 4 months current year retained earning from 4,500, then automatically you will get the retained earning at 1st June X0. Current year earnings. Let's see. It's here. Sanford profit for the year is 3,900. So Sanford profit for the year is 3,900. What are we going to do? Simply 4,500, simply deduct last 4 months retained earnings from this. You will get retained earning at acquisition. Repeat. Examiner has given us the retained earning on 30th September X0, but we need retained earning on 1st June X0. Means you have to go reverse 4 months back. So what we are doing, we're just deducting earnings of the last 4 months. Current year total earning is 3. Basically, what happens, we take opening retained earning, add profit for the year, and then we get closing retained earning. Examiner has given us the retained earning 4,500, which is, you can say, a retained earning at reporting date. But we need to find out the retained earning 4 months before the reporting date. For that, you just deduct the earnings of the last 4 months. If I deduct the earnings of the last 4 months, I'm getting a retained earning at acquisition 3,200. Now come here. Because acquisition period is just 4 months. So logically from 4,500, we are deducting earnings of the last 4 months. So we're getting retained earning at acquisition 3,200. It means in the post-acquisition earning is 1,300. We have been given a fair value adjustment of the property, but this time, in this question, fair value adjustment is not positive, it is negative. Value has not increased, actually value has reduced. So we'll deduct property fair value adjustment. Value has not increased, it has decreased. It is 1,200. We can go back and read it again. Let's see. At the date of acquisition, the fair values of Sanford asset were equal to their carrying amount, with the exception of property. This had a fair value 1.2 million below its carrying amount. 1.2 million below its carrying amount. So there is a fair value adjustment, but it's not positive, it is negative. And remaining life is 8 years. Now listen carefully. Now, instead of additional depreciation, we will reverse, everything will be opposite. When I explained you in the previous class, so in that previous class, we took a positive fair value adjustment. So the net asset, they were increased. And after that, there was an additional depreciation. Now, it's a negative fair value adjustment, and now there will be a reversal of depreciation. Due to reversal of depreciation, your net asset at reporting date, they will increase. Repeat. Your fair value adjustment is not positive. Try to understand. It is negative. So 1,200 divided by 8. 1,200 divided by 8 into 4 upon 12, because post-acquisition period is only 4 months. So there's a depreciation of 50, but this time this 50 will be a reversal of additional depreciation. We will reverse this depreciation. Why? Because property value is decreased. It is the opposite if the value increases. So we'll add reversal of additional depreciation. Actually, your subsidy is depreciating more amount. Rather, it should have depreciated less amount, because the 1,200 decrease subsidy is not considered in its individual books. So value has decreased. So it is not a positive fair value adjustment, it's a negative fair value adjustment in the depreciable asset. So now there will be a reversal of additional depreciation. If the fair value adjustment was positive, then we would have written 1,200 in positive, and then we would have deducted additional depreciation 50. Since the fair value adjustment is decreased, that is in negative, so the depreciation amount will be in positive. Now let's go back to the question. Now look at the point number 2. When I was discussing formats, okay, in first class of the consolidation, I did discuss when seller is the subsidiary. If seller is the subsidiary, then unrealized profit on a stock or unrealized profit on anything. If seller is the subsidiary, it will be deducted. Unrealized profit will be deducted from the net asset at reporting date. Now let's see. Premium had 2 million at a cost to premium. Obviously, parent is the buyer, so it is 2 million cost for the buyer. of inventory that had been supplied in the post-acquisition period by Sanford. Sanford had sold these goods to parent at 30 September X0. Sanford made a markup on cost 25% on these sales. Now try to understand. When we say markup, logically markup is a percentage of cost. So cost plus profit is equal to selling price. In case of markup, your cost is 100%. Profit here it is 20. It means selling price is 125%. If examiner uses the word margin, margin is a percentage of revenue. Cost plus profit is equal to selling price. In margin, the selling price is 100%. Assuming the cost is 75, then profit is 25. Here the seller is subsidiary. Here the seller is subsidiary number one, number two. Subsidiary is charging 25% on cost. Charging 25% on cost means we are dealing with markup. Repeat. Subsidiary is the seller number one. And number two, subsidiary is charging 25% on cost. Cost means markup. It means selling price is 125%, cost is 100, and the profit margin is 25%. If 2 million is a cost to the parent, obviously 2 million is a sale value for the subsidiary. If I'm the buyer, whatever I'm going to pay you, that will be cost for me. And for you, it will be a sales value. 2 million is cost for the parent. So obviously the same 2 million is selling price for the substrate. And in case of markup, markup is a percentage of cost. We know that selling price is 125% because of 25% markup. We'll take 2000, 25 upon 125 to calculate unrealized profit, which is 400. Number one, the seller is subsidy. That is why in working number two, unrealized profit will be eliminated from the net asset at reporting date. Second, it is a markup. So 25 upon 125 will give us unrealized profit. Let's deduct. Less unrealized profit. Unrealized profit on stock. Simply I'm taking 2000. 25 upon 125. I'm getting 400. So simply 5,000 plus 3,200 minus 1,200 gives me 7,000 fair value of net asset at acquisition. Here, 5,000 plus 4,500 minus 1,200 plus 50 minus 400 gives me 7,950. So obviously it is 950. Working 2 is the net asset which we have calculated. Now let's go for working 3, that is goodwill. Let's take first cost of investment of parent. Cost of investment. Parent has issued shares as well as paid the cash. Let's go to share exchange. On 1st June X0, Premier had 80% of the equity share capital of Sanford. And consideration consists of two elements, a share exchange or a three shares in Premier for every 5 acquired in Sanford and a cash 8 lakh. The share issue has not yet been recorded, we'll record it. And market value of the parent share price at acquisition is $5. Subsidies share capital is 5,000. Par value is 1. So obviously number of shares will be 5,000. Parent has acquired 80% of that. And parent has issued 3 shares against 5. It means if I just calculate how many shares parent has issued. So 5,000, 80%, 3 by 5, I'm getting 2,400. Logically, Parent has issued 2,400 shares. If parent has issued 2,400 shares and one share is having a market value of 5, it means share exchange is having a fair value 12,000. Repeat. Share capital of subsidiary is 5,000, par value 1. If I divide share capital 5,000 with a par value 1, I'll get obviously 5,000 shares. Parent has taken 80% holding. So we have taken 80% of 5,000, and then parent has issued 3 shares in his company against each 5 shares and subsidy which parent has acquired. So 5,000 into 80% to 3 by 5, it gives us 2,400. It means logically parent has issued 2,400 shares. And we know that par value is 1. So with the 2,400, parent share capital will increase by 2,400, and over and above the value which is over and above the 2,400, that will be taken as a share premium. And we will do that because it is written that parent has not recorded this transaction. Let's come here. So shares. Subsidies number of shares are 5,000. Parent has acquired 80% of that. 3 by 5 into $5 because parent's share price at acquisition is $5. I'm ignoring 3 zeros. So shares are having value of 12,000. Parent has given the cash, which is 800. Fair value of NCI they have given us directly. Fair value of NCI is 3.5 million, means 3,500. NCI value at acquisition they have given us. NCI value at acquisition. It means 12,000 plus 800 plus 3,500. I'm getting 16,300. Now simply deduct fair value net asset at acquisition, which you will get from working to, less fair value of net assets at acquisition, working to, and fair value of net asset at acquisition is 7,000. Here comes the goodwill on acquisition. $9,300. Let's see the impairment. I think they have given us the impairment loss. Goodwill is impaired by 1,500. Impairment is 1,500. Goodwill as per SOFP. SOFP. 7,800. Let's go for working 4 to calculate NCI. Non-controlling interest. First, we have to take NCI value at acquisition, which we have which is given to us in fact. NCI value at acquisition. NCI value at acquisition is 3,500. Now simply add NCI share of post-acquisition reserves. Add NCI share of post-acquisition reserves. That's working to, come here, 950. parent's holding is 80%, so it means NCI holding is 20%. If I take 20% of 950, I'm getting 190. Less NCI share of impairment loss because NCI is capped at fair value. If we keep the NCI at proportionate of net asset, then whatever the impairment loss comes, that only belongs to parent. Then we will never give any impairment share to NCI. Right now, we will give 20% of impairment loss share to NCI because NCI is capped at fair value. Less NCI share of impairment. NCI share of impairment. In working 3, impairment loss is 1500. 20% of this belongs to NCI because parent is having 80% holding. So NCI is having 20%. So 3,500, 190 minus 300 gives us 33. So 3390 will show in SOFP. Working 5 and the last working group retained earning. Let's calculate group. Retained earnings. First, we have to take the retained earning of parent, that is premium. Let's see the retained earning of parent. Retained earning of parent is 12,300. Retained earning of parent is 12,300. Now simply add share of subsidiaries post acquisition reserves. Add share of Sanford post acquisition reserves. You will get this value from working 2. In working 2, it is 950. 80% belongs to parent because parent's holding is 80%. We have given 20% of that to NCI. So that is 760. Less share of impairment loss. Share of impairment. Working 3, impairment loss is 1500. 80% belongs to parent because parent is having 80% holding. So here comes the group retained earning. 12,300 plus 760 minus 1200. 11,860. So the group retained earning is 11,860. Now let us try to prepare group SOFP. Consolidated statement of financial position. As at 30th September 2000X0. Obviously, first we have to show non-current assets. Non-current assets. Let's ignore 3 zeros. We'll take property, plant and equipment. Property, plant and equipment. Property, plant and equipment, let's come here. Parent is having a property, plant and equipment 25,500. Subsidy is having a property, plant and equipment 13,900. So we'll take 25,500 plus 13,900. We do have a fair value adjustment, but this time it is not a positive fair value adjustment in the depreciable asset, it is negative. So we'll deduct 1,200. That is fair value adjustment. And there's a reversal of depreciation by 50. So reversal of depreciation will be added. If you go back to working two, you can see that we have deducted 1,200. So we do have a fair value adjustment, but it's not a positive, it is negative. But there's a reversal of additional depreciation, so 50 will be added. So let's calculate property, plant and equipment. Parent is having 25,500. Subsidies, property, plant and equipment is 13,900. Now 1,200 is a fair value adjustment. Take from working two. Reversal of additional depreciation working two. I'm getting a total amount of 38,250. After that, let's take goodwill. From working three. Goodwill is 7,800. Now let's see the investments. Come here. Investment amount is 1,800. Now please listen carefully. The amount of investment which parent has made in subsidiary. If parent has recorded that investment, so it will not be shown in group SOFP. Obviously, parent has, in the form of in consideration, parent has given shares of its company as well as cash paid. It is categorically written in the question that share issued by the parent has not been recorded. It means cash paid by parent is recorded. So from this 1,800, I'll deduct 800. This is the cash which is paid to the subsidiary. When we prepare group SOFP, we never show parent investment in subsidiary. So we will exclude 800 because this 800 is recorded. So parent investment in subsidiary will not be shown in the group SOFP. Okay, what else? Now, if you come here, let's see this. Point number 4. Premier's investment includes investment in shares which at the date of acquisition were classified as payable through OCI, IFRS 9. The investment has increased by 300 during the other equity reserve related to these investment is based on their value at 30th September W9 previous year. There were no acquisition or disposal, so they have not recorded this 300. The rise of 300 they have not recorded. It's a different investment. It is not the investment in subsidiary. So please look at this. What are we doing when it comes to investments? Amount of the investment is 1,800 minus 800 because 800 is cash paid to the subsidiary. This is the investment which parent has made in subsidiary. We will not show that in group SOFP. And there's an other investment which has increased by 300. And this increase has not been recorded. So we have to record. So 1,800 minus this, I'll get 1,300. So 38,250 plus 7,800 plus 1,300. I'm getting 47,350. Okay, now let's go for current assets. Inventory. Simply we'll take parents and subsidiary inventory minus unrealized profit on stock. Because when we eliminate unrealized profit on stock, then stock will be credited. So inventory. Parent's inventory is 5,300, subsidiary's inventory is 500. We will minus the unrealized profit on stock, which is 400. Because due to unrealized profit, stock will be credited. And in working two, you can see that 400 value is shared. So very easy to calculate the inventory value. Parent inventory is 5,300, subsidiaries having the inventory value 500 minus unrealized profit 400. Unrealized profit on stock is 400. So I'm getting 5,400. Now let's go to receivables. Let us first take the receivable of parent, which is 4,200, receivable in subsidiary, which is 1,100. Let me show you these values. Receivables. Parent is having a receivable value of 4,200, subsidiary is having a receivable value of 1,100. Now, if there is any intra-group transactions, payable, receivable, that will be eliminated. Parent is having a receivable of 4,200, subsidiary is having a receivable of 1,100. Let's read. Okay. Point number 3. Premier had a trade payable balance owing Sanford 350 as at 30th September X0. So parent is saying that we have to pay 350 to the subsidiary. This did not agree with the corresponding receivable in Sanford books due to 130 payment made to Sanford, which Sanford has not yet recorded. Basically, parent has paid 130, but that logically that 130 is cash in transit, which let's say subsidy is not recorded yet. So basically, parent is having a payable of 350 to subsidy. It is not matching due to 130. Parent has made the payment, but let's say subsidy is not recorded because they have not received. So logically, if you ask the double entry, I'll say payable will be debited by 350, cash in transit debited by 130, and receivable will be credited by 350 and 130. You can add them, no issue at all. So payable will be debited by 350, cash in transit 130, and receivable. You just add both of them. 350 plus 130. So come here. Receivable. 130, that is cash in transit, minus 350, which is intra-group. 350 is intra-group. So 4,200 minus plus 1,100 minus 130 minus 350. I'm getting a value of receivable 4,820. Now simply take the value of bank. Parent is having value 3,000, subsidiary is having 800, and we'll add cash in transit 130. Cash in transit 130. I'm getting 3,930. So total of the current asset is 14,150. Current asset and non-current asset. Non is 47,350 plus 14,150. I'm getting total asset 61,500. Total assets are 61,500. Now let me show you the values of the bank. Values of the bank. Bank. Parent is having 3,000, subsidiary is having 800. And we just added cash in transit. Now, let's go for equity and liabilities. And let's try to balance the SOFP. Equity. We'll show share capital of parent only. Parent is having a share capital of 12,000 plus Parent has issued 2,400 shares with a par value of 1. How did I get this 2,400? I think I have shown the calculation somewhere. Let's come here. It's here. Subsidies share capital is 5,000, par value 1. If I divide 5,000 by 1, I'll get 5,000. Parent has acquired 80%. 80% of 5,000. Then parent has issued 3 shares against 5. So actually, you are getting 2,400 shares. So parent has issued 2,400 shares to the subsidiary. Par value is 1. It means 2,400 multiplied by 1 will get share capital and multiplied by 4 will get share premium. Because parent share price at acquisition is $5. So 1 is the par value and over and above par is $4. That is share premium. It means and already share capital of parent, you can see that it is 12,000. So that is 2,400. And let me show you the working. 5,000 shares into 80%. 3 by 5 into $1. You will get 2,400. So 14,400. Share premium. 5,000 into 80%. 3 by 5 into $4. Parent's share price at acquisition is $5. 1 is the par value, over and above is $4. That is representing the share premium. So we are getting 9,600. Okay, now let's take other equity reserves. Other Now, what do you mean by other equity reserves? Let me show you. Other equity reserve, parent is having other equity reserve 500. Parent is having other equity reserve 500, but this 500 value belongs to 20W9. There's a current year rise in the investment by 300, and that investment belongs to fair value through OCI category. We know that in case of fair value through OCI, when the value increases or decreases, it goes to OCI. And we also show that into other equity reserve. And there's a gain in the investment by 300, which parent has not recorded. We will record it. So investment is debited by 300 and other equity reserve will be credited by 300. So already it is 500 plus 300. This is gain on fair value through OCI investment. Group retained earning working 5 we have already calculated. Group retained earning working 5. Let's see. The value of group retained earning. It is 11,860. So if I simply add this 14,400 plus 9,600 plus 800 plus 11,860, I'm getting 36,660. Now let's take the NCA, non-controlling interest from working 4. Non-controlling interest. We'll take it from working 4. Non-controlling interest working 4. It is 3390. 40050. Now let's go to liabilities. In question, we do not have non-current liabilities, we have only current liabilities. So we'll take current liabilities of parent, which is 15,000. Current liabilities of subsidiary 6,800. Let me show you this. We do not have non-current liabilities. We have only current liabilities. Parent 15,000, subsidiary 6,800 minus intra-group balance is 350. Parent says I have a payable to subsidiary 350. Premier had a trade payable balance owing to Sanford 350. So since it's an intra-group balance, it will be eliminated in the group accounts. So minus 350 intra-group balance. So I'm getting 21,450. So 21,450 plus 40,050, I'm getting 61,500. That is total equity and liabilities. And I hope it should be balanced with the total asset. Yes, it is happening. So students, we have discussed, I would say it's a very old past paper question, but slowly and gradually we'll be discussing the recent attempts paper as well. This is the first question from the past paper. In the coming class tomorrow, what we are, number one, I'll be discussing the concept of associate in SOFP, and then we'll start doing a past paper question in which you will be having parent, subsidiary, and associate. So thank you very much, student, watching this lecture. Have a nice life.